I'm Charlotte McLeod with investingnews.com, and here today with me is John Kaiser of Kaiser Research. Thank you so much for joining me. Great to have you here.
Charlotte, thank you for having me on your show.
Really good to have you back. It has been a little while since we last spoke, so it'll be really nice to catch up. And one reason that I thought it would be good to check in with you is because I think you'll be able to help with a question that I see among a lot of investors in our audience, which is we have the gold price at or near all-time highs. So when are the gold stocks, especially the gold juniors, going to start to move? And I know in your writing and on your podcast, you've talked about the idea of the disappearance of the American gold bug. So I thought that was quite interesting, and I thought we could begin there if you want to explain that concept.
Well, the reason gold has been rising is not so much because the world expects fiat currency debasement and the U.S. debt to eventually implode. That would have been the talking points for the last 30 years while I've been in this business covering the resource junior sector. Now, at all these conferences where we used to go to, hard assets and that, it would typically be, your Republican type voter who fancied himself or herself a libertarian and fretted about this fiat currency debasement. And they talked about Milton Friedman and Ayn Rand and libertarianism and freedom and all this kind of stuff. But since Trump became president, he has kind of done a takeover of the Republican Party. So the traditional things that Republicans were concerned about, they're no longer concerned about that. So they are now into crypto and stuff like that. So gold has been, in a sense, orphaned from the traditional audience. Now the liberals, the Democrats and all that, they treated it as this barbarous relic from the past and shunned it simply because the Republicans basically commandeered it and said, yeah, this is our story. The liberals were more interested in all the base metals and other things that are required for growing prosperity in the world. So right now, even though we have gold, gold bottomed at in 1895 in mid-February and has rebounded since then, it's gained 25% during that period. Now, it's not the case that the gold producers, the majors and intermediates have failed to respond. The majors, not counting the ones that have problems, they're up 45 to 90% from where they were when gold bottomed in February. And the intermediates are up from 50% to 132%. But the disconnect has people mumbling it, but gold's at a record high. It's over $2,500. Why is that not ringing bells? Why is that not unleashing a major buying binge? Well, the problem is the optics. 25% is not a big deal. Now, if you take gold from $400 in 1980 and inflation adjusted to the present, it should be about $1,554. So the current level is actually about a 60% real price increase for gold. And this is important because gold has said, it hedges against inflation. Yes, gold has tracked inflation, but it's also done more. And one of the reasons it's done more is that the world is starting to back away from relying on the U.S. dollar as a reserve currency. And the Ukrainian invasion, the Russian invasion of Ukraine and China's alliance with Russia and the sanctions this unleashed, this has accelerated the desire to withdraw from the U.S. dollar. So they're now trying to trade with their own currencies a lot more. And the central banks have resumed buying gold after a long period of liquidating it. It's still just a drop in the bucket what they are buying. But there is this sense out there that, yes, America has peaked and America is going to descend or decline relative to everybody else. And that's also not a really good talking point for, your traditional gold bug. Even though they were bashing America, it was all because America was, extending welfare, the social security net and all that. They don't like that. They didn't like taxation. Now the talking point is, America has peaked. And if we have another, things continue as they are, it will get a lot worse. So buying gold is kind of like doing a thumbs down vote on America. But it's the rest of the world which is looking at the possibility of a Trump victory, which is, even though he will lose the popular vote, the electoral college system is so precarious that it's 50-50 who will end up. And if he comes through with all his threats of withdrawing from the global stage, turning the United States into a type of hermit nation, isolationism, that will make the rest of the world not be its friend at all. So people are starting to buy gold as a hedge against this uncertainty. And this nonsense of buying crypto is a digital mirage that refers to itself and is priced in US dollars. So who cares what that goes to? Whereas gold is a physical something. It's fungible and it's stored energy, and you can't make more of it come above ground very easily. So this needs to change. I mean, when we went from $300 to $1,900 from sort of 2003 to 2010, that was a 500% gain. People saw that. But what they've seen in the past this year, 25%, no big deal. So all these things are conspiring, and it's a question, what will actually be the trigger to make people get excited about gold heading higher and then starting to leverage money through the, not just the producers, but also the advanced gold companies with ounces in the ground and the exploration juniors.
Do you have any thoughts on what that trigger could be?
I think the election is going to be a very scary period because, Trump denies that he lost the election, claims it was stolen. If he happens to lose again, he will insist that this was the case. And there'll be a lot of people out there ready to start rioting, to cause a huge fuss. The whole world will be watching. And if this does unfold and people just say, okay, enough of this senile blowhard, he's lost, we're done with him, let's keep America great, rather than accept his contention that America today sucks, is no longer great, which is a bit of a slander as far as I'm concerned. And that, even if they say goodbye to him, we still have this problem of geopolitical conflict, of the global East squaring off against the global West, and the global South looking this way and that way, who butters our bread better. And right now, China can butter everybody's bread better than America can or will. So that's going to, I think, even regardless of the outcome, we're going to see gold trend higher. And that's I think what's going to be the trigger.
Okay, thank you for going into that. I think that really helps paint a picture of what's going on with gold and the gold stocks and when that might start to change. But as we were getting ready for this interview, we were talking about problems among especially the juniors that apply to gold juniors as well as other juniors throughout the resource space. One of those issues, these are kind of behind the scenes things going on, was intraday naked short. So I wondered if you could go into that. Tell me about why that's a problem for juniors.
Now, this applies more to the discovery exploration juniors, whether it's gold or base metals or whatever. And the problem is that they introduced these alternative trading platforms in the name of preventing the TSX from having a monopoly. But the problem with this, because of the different timing of how orders go through these different trading platforms, and the brokerage firms, they have algorithms that calculate which is the cheapest way for them to funnel an order through. So the original concept of one order book, the way the stock exchange used to be, you put in your bid, your first come, first serve, which is once electronic trading started, that's what it was in the beginning. That has now been undermined. But the problem with these alternative trading platforms is that the old uptick rule, where you cannot sell short except at a price that's higher than the last different price, you couldn't prove that anymore. It became physically impossible. The United States realized this right away, and they killed the uptick rule, and then Canada followed suit. Now, you still have to borrow stock, and most of these juniors are not in margin accounts, and they're in segregated accounts, so it's very difficult to borrow the stock. So this new horrible thing that's happened in the Canadian markets is that these brokerage firms, these banks, have these trading departments where they sit there and literally monitor the activity in the juniors, and they look for incoming risk capital. So a company puts out a news release with some incrementally positive news about an exploration program that's coming. People get excited, start to buy, and then they hit a wall of selling that isn't just usually the promoters who are trying to dump it. Now you have these capital strippers. They just sell short into it. And they know they only have to intend to borrow the stock for the next day. So what happens is they can keep selling, and when the buying dries up, they can lean into the bid side of the order book and continue selling naked short on a downtrend. And that, of course, triggers a cascade of despair amongst the ones who just bought it. For the longs are hoping, yes, we're going up to a new level. This project is evolving. And so they end up liquidating. And this enables these predatory traders to cover their shorts so that the need to borrow never happens. So that's why you have the right term, intraday naked short selling. They intend to borrow the stock, but they never have to because they have overwhelming power to crush it. And this is bad for the resource juniors because it prevents the market from serving as a price discovery mechanism. One of the hardest things with these juniors is to quantify, well, what is the fair value for this project? And we have new information. And so that allows us to rethink, okay, we have bigger gold zones or whatever, and that means the price should be higher, but where exactly that is, well, the market's supposed to decide that. But when you have this capital stripping happening all the time, these companies get stuck in a dilution treadmill. They're always financing at a lower price. And what can be done about this? I'm not sure anything. We need a raging bull market so that there's a huge amount of new risk capital in so that the traders, they suddenly lose their shirts because there isn't a cascade of selling by the end of the day. But it's the event-driven nature of these exploration plays. Like every month or so, you get a press release and then nothing, just silence from the company. And this industry knows this. And they know that there will be no fresh news to mobilize people. That's why having something like gold excite people, get the animal spirits going again so that there is this backdrop of a growing audience that's seeing this is a trend as opposed to a flat-lying place where if you enter these waters, you're just going to lose whatever your shirt as when you go in there.
Really interesting to go into that. And I'm glad you addressed, how can this possibly be fixed? How can this possibly turn around? One of the other points that we were talking about before we started this interview is the problem of accredited investor status. So there's a pretty high barrier to entry there. And as a result, people who might want to participate in things like private placements aren't necessarily able to do so. And that makes it harder for juniors to access capital. So I know this is something that you've been speaking about for years. So I'm wondering if you could go into it and maybe talk about what you would want to see change there.
Yes, so the accredited investor rule allows you to participate in private placements. And what it says is that you need to have a net worth of $1 million or more between yourself and your spouse, and it cannot include the equity in your real estate. So that's a pretty high bar for most people, and it's a bar definitely for the younger generations who are not going to have $1 million in that worth. So the Canadian pool of such investors is small. Now, theoretically, the U.S. pool is, it's 10 times larger. However, the U.S. has this own protectionist rule called 144, where there's a special legend attached to a private placement certificate. Even if you're an accredited U.S. investor, it's very difficult to get rid of this legend. So this discourages U.S. investors from investing in these Canadian juniors. Now, I started complaining about this a decade ago, saying these juniors need to be able to raise money from a larger pool of investors. And with the with the brokerage sector shifting to asset gatherers, where they're only interested in high net worth investors, in other words, accredited investors, all the smaller retail investors, they had to go to the discount brokers. And the discount brokerage firms really don't do financing. So if they want to do financings, they would have to do it with the company. But the accredited investor rule was an obstacle, so the companies couldn't really tap into this money unless everybody lied about how rich they were and so on. The regulators listened. They introduced something called LIFE, listed exempt financing exemption, listed issuer financing exemption, and you don't no longer need to be a millionaire. You just need to write a check, and it's free trading instantly. But they've made it difficult for companies to deal directly with ordinary people because of the paperwork involved. So who's doing the life financings? Well, it's the establishment brokerage firms with their high net worth, already accredited investors, and using this to have the private placement paper free trading, which of course also helps them to short it out in advance before the financing. And so you now have the structural problem of the stock going down after a financing is announced and then never coming back because it's there's all this instantly free trading paper that's looking to clip the warrant. And that's another bane of these warrants that they attach to these private placements. There's a Canadian culture of clipping the warrant and flipping the stock as soon as they get it, and then just have a free ride on the warrant. And this, of course, creates a big overhang in the market also, because then you can short against those warrants too, because you actually have you're protected against the stock taking off. So they really need to make it easier for companies to deal directly with retail investors, to use the life exemption to get these smaller amounts of monies into companies. This is especially important for the discovery exploration juniors, not so much for the advanced ones, because those are looking for much bigger amounts of money. But these $500,000 to $1 million financings, those are key. And we are seeing a very big drought in financing stuff. The number of small financing is increasing. This money is clearly going into just overhead to keep the lights on. And I have a couple stats here. By the end of July in 2021, $2.8 billion was raised by TSX Venture resource listing. In 2022, it was $2.1 billion. In 2023, it was $1.7 billion. And this year, it was only $1.6 billion through these the private placement mechanism. So we're in kind of a financing death spiral. And without getting money into these companies' treasuries, they can't do anything to change the fundamentals.
Okay, this is also very interesting to go into. And so as we have all these issues with companies raising capital, there's all these barriers. There are also lifestyle type companies that never seem to do anything, and yet here they are kind of continuing along. So that seems to be a problem too. And I'm also wondering what can be done to address that situation.
It completely puzzles me that even though we're now in the 12th year of a bear market that began in 2012, that there continues to be a flood of these small rinky-dink companies listing on the venture exchange, on the Canadian Stock Exchange, with mediocre properties. There's nothing interesting about them. They just keep coming and coming, as if nobody got the memo that there's no audience out there for these stories. Now, Australia, the ASX, they have a pool of about 500 to 600 companies, and that's pretty stable. That hasn't gone through the roof. They don't have this dilution. Yes, they do. They do change stories and that, but they don't do these rollbacks, which is why you end up with billion-share companies on the ASX, whereas here, now we're seeing these rollbacks. They roll it back 10, 20, 30 for one, down to like 5, 10 million shares, and then they puff it up again with more financings. But the real solution to this is a smarter market. Like, just ignore companies that don't have interesting stories. So my view is, over time, that these will just wither away because there's no market interest in them. Now, this is the bad thing. If we do get a roaring secular bull market for resource juniors back again, these guys will be able to harness some of that money coming in. But that may not be so easy, because the older generation, my boomer generation, we're thinking about, we might live to be 90 plus, and we need to preserve our capital. And this game isn't what it used to be in the 80s and 90s. It's much harder to make money in the resource juniors. So we're reluctant put that in. And insofar as we've got our money with a major brokerage firm as sort of asset gatherer, they have all kinds of rules which prevent them from pitching any of these juniors, and they will even deny me an unsolicited order to buy a junior because it's risky. I'm a foolish old man who's like gonna become poor, and then some of my kids will sue the brokerage firm when they find out that they let me do all these trades. So the younger generations, they are the millennials, the Gen Z. They know nothing about the resource sector. They don't even know where the stuff in their iPhones and that comes from. They're pretty ignorant. They've been taught, oh, mining's bad. Yeah, mining's bad when it's in our backyard, but they forget that it happens elsewhere where there are no rules and no protections for downstream victims. So they're completely myopic about the situation. Plus, they know nothing about geology and that. And we need to get these audiences to become interested in fundamental outcome gambling that stretches out over time, where you have events, where you have a vision of what this is supposed to be. Right now, they chase ETFs and crypto and whatever meme type thing where you don't need to know anything except pay attention that you're on the right side of the trend, that the trend continues to be your friend. But if we start getting this audience interested in this sector, there's a huge educational thing that has to be done. Teach them how to think. What is the size of the prize? How do you price it when it's like at the grassroots target testing stage? And the models for that exist, but it takes work. And that's the biggest thing that needs to happen, is teach these younger generations how to think about mining plays, because mining plays are not like winner-take-all stories. They are like have a 20-year mine life. The discounted cash flow model, they have an upside limit. And a good metaphor I've been trying to present to the people out there is that of the California gold rush. Now, we used to think at the juniors, yeah, each one of us is a 49er. We're going to go to the mother lode belt and we're all going to individually strike it rich. But the juniors, and especially with the base metal ones, the critical mineral ones, they're really like the outfitters in San Francisco who set up shop and sold a pick and shovel to every 49er that went through. And you could quantify what the upside limit was based on how many people were coming through and how long the gold fields were going to continue playing out. A mine is like that. You can calculate the upside limit. And that makes it different from like trying to gamble which of these 49ers is going to be the winner who takes all. No, the resource companies are not winner take all. It's not like technology or anything like that. It's different. So that becomes the gateway to teaching the younger generations. You can think quantitatively about this stuff. It's interesting, and it's a form of entertainment too. That you're not wasting your day monitoring stuff, doing day trading type stuff. You're actually gambling over extended periods. I mean, we see this in the fantasy sports and all that happening. Why can't it happen in this sector? So when this happens, people will be able to distinguish between those that actually have a real shot and those that do not. And the game is getting tougher anyways, because you now need to look into the third dimension, underground, undercover. Everything's been pretty much picked over on surface. You're not going to trip over an outcrop anymore. That requires bigger dollars. It requires computation ability, talented teams. For example, one of the companies, prospect generator follow is Kenorland. They've done a fabulous job generating plays that are actually grassroots plays, but they gather additional information. They make it part of it. And they even attract majors as farm-in partners. So what's required to be serious, it's rising a lot. And these little rinky-dink companies, they will not be able to compete because they will not have the talent base to qualify for the new requirement for the next wave of exploration.
Right. So clearly there's a lot of challenges out there for juniors and mining companies. One bright spot that I would think is positive is places like US and Canada have all these critical minerals goals in terms of production and developing the supply chains. But again, as we were speaking about earlier, the permitting times and for getting projects into development are quite long. They seem to be getting longer. So I'm wondering, is there a point where these countries take a look and say, okay, we have these goals, we actually need to speed this up?
Well, in the United States, the USGS for the past 5 years has been sounding the alarm about critical minerals. Where do they come from? And they've published all kinds of information, global maps showing where all the carbonatites are, all these different types of deposits, and I've published a map which is on or a graph on my website which shows the 50 metals. It shows in red the combined percentage of Russian and China supply compared to the American supply in blue. And so you have a few little tiny posts along the bottom which represent American supply, and the overwhelming supply comes from Russia and China. And if we have this geopolitical conflict between global East and West get worse, and I can't imagine how it can get better, we have the biggest economy in the world is going to have a supply problem, because although there's all this talk about deglobalization, it hasn't yet happening. Everything is still flowing around, but people are aware. But nobody is doing anything about it. There is a paralysis, this assumption that it will all go away. We will continue to get all the metals that we need. I mean, it's like with gallium. They're wailing now that China has a ban on export, and China supplies 80% of the gallium, and it was like all of $170 million worth of gallium produced last year, stripped as a byproduct from converting bauxite into alumina. And the price is pretty much the same level it's been for the last 20 years. So nobody can really compete. And this, it's why are they complaining about this, China banning it? Why aren't they encouraging companies to recover it from zinc deposits and the refining, nail a higher price to the wall, maybe slap tariffs on the Chinese stuff? Because the Chinese stuff, even when they ban it, it still gets smuggled in, because the Chinese will just put it through Myanmar or some other channel and send it to the West that way. So this needs to change in a significant way. And in Canada, all this fuss about critical minerals, we even have special sort of tax deals, but it's the permitting cycle. In the United States, it's mainly NIMBY, not in my backyard. And in Canada, the huge new problem is UNDRIP, Canada signing on to the Indigenous Rights United Nations manifesto. And this has injected this consultation requirement, which the companies are required to do, but the First Nations aren't. So it drags everything out far longer. And this is deadly to the resource juniors, because right now in places like Africa, South America, it's becoming ever more difficult for juniors to get anything done there. So they're retreating to the United States and Canada. And Canada is supposed to be this resource-rich country where there's all this stuff left to find. It could probably keep America fed with raw materials for many, many decades. But the big majors, they're not doing the exploration. They're busy trying to develop big deposits that have already been found. And it's really up to the juniors to start looking undercover, to start looking for these more subtle deposits using geophysical techniques, geochemical techniques that use subtle, envelope alteration system type knowledge to track these things down. And anyways, these obstacles are colliding with the funding cycle. You need to expand your program. Now you got to sit around for 6-9 months to get the permit expanded. This also kills investor interest in the juniors, because you want to be able to keep moving the project along in response to good results. You don't want all these delays due to all these consultations that need to be done.
So it's, as you've been outlining, it's very tough out there for the juniors. And I think I have to ask, as we're getting toward the end here, how are you investing in this environment? Where do you see opportunity?
I have about 10 favorites in my collection for 2024, and they're already down as a group by 15%, and it's a pretty broad selection of companies, both advanced projects and exploration in various metals. But personally, I have been buying only 4 companies this year. One is Vista Gold, and that's a classic example of a company that did his feasibility study, is permitted, updated it in March, so we have all that inflation caught up. And this stock is trading at about 60 cents US per share, even though the discounted cash flow model at $2,500 gold says it should be a $5 plus stock. So I'm buying a stock like that because if gold simply stays here and inflation remains subdued, eventually this will get bought out by one of the bigger producers or even one of the intermediates to add more ounces to their portfolio. Now, at the other end of the extreme, Solitario Resources Corp, it's my exploration junior. Now, they spent over 2 years getting a permit for the Golden Crest project, which is in the western part of the Dakota Hills. They have finally started drilling. This may be the last spectacular gold discovery frontier in America because of the nature of the gold, basically invisible. It was overlooked by the panners who came back there 100 years ago when Homestake was discovered. They didn't find anything in the pan, so very little was done in this area until this junior came along and started poking around, and they've been amazed that when you assay this boring-looking rock, it comes back fantastic. So that could be a fantastic gold discovery, which scales from like maybe a 4 million ounce system to all the way to a mirror image of the Homestake system, a 90 million ounce system that they pretty much control. And in the other metals, PJX Resources, it's they put out a press release last October which had a photo. You needed to see the photo, say, oh my gosh, Sullivan 2 is finally a reality. Outcropping somewhere, not buried deep under 1,000 meters of junk rock. They have found something that looks like the Sullivan deposit. So again, they thought they'd have the permit by May. With all the extra special consultations, they didn't get it until early July, and then they still had to do stuff. They only started drilling in about the second week of August. So that could be a huge discovery play if it turns out that this horizon does have size and scale. And then for oddball type of things, I'm looking at one called Nevada Organic Phosphate. And it's a nickel stock because they don't yet have title. Next week, I could get the bad news that the BLM says, no, we're not going to grant this lease permit for the Murdoch Mountain Phosphate project. What's fun about this story, it's different. This is low-grade phosphate, but the toxins are all below the required level. So it could be a whole rock organic product. They just mine it, grind it up, and sell it to the whole organic farming community out there. So this is something brand new and interesting. So these are the four that I've been buying. This last one, in a week, I could be singing the blues because they denied it. On the other hand, if they finally approve it, here's a shot where within a year we know that they have something that could go from 55 cents to maybe $1 and be acquired by one of the big ag fertilizer companies. So that's the sort of stuff I'm looking at in this very, very tough market.
Yeah, I appreciate you going through that broad range there. I think there's different things for people to look at if they choose to look further. As we're finishing up here, I'd put it back to you and just ask if there are any final thoughts that you would leave investors with in what is a tough environment for juniors.
I think the thing to do now is while we wait for a trigger, a match to light a secular bull market for the resource juniors, is to start educating yourself, familiarize yourself with the discounted cash flow model, and start understanding how to quantify this. When in the 90s, 80s, when I started, no idea how any of this stuff worked. We just chased the momentum stuff like people do today. But today there's so much more competition that's pure momentum. The juniors cannot compete. But precisely because they have an upside limit, you can actually think mathematically about what's going on, and you can choose when to sell and when to buy. And the irony is when I do all my calculations like this, everything offers really good speculative value. In the 90s and the 2000s, everything was poor speculative value, so you just had to do a relative game. If you believe that this will turn around, now's the time to get educated and be ready to move during what could end up being a 5-year plus cycle as the world adapts to securing raw material supply in secure jurisdictions.
Okay, well, thank you very much for going through all these different topics. I think this was very educational for me and hope to have you back again soon.
Hopefully. Thank you, Charlotte.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is John Kaiser with Kaiser Research. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.